It's wonderful to be here in Singapore, my very first trip, believe it or not. So it's a long trip. It takes some dedication to get here, but I'm very glad I am here. And hopefully the jet lag will kick in after my remarks. Look, I want to commend MAS and Elevandi for the particular topic of this discussion this morning, because with the spectacular implosion of crypto markets, which we've seen recently, 8% peak-to-trough losses, prominent failure of a number of crypto firms, a collapse of Terra stablecoin, I think this is all making regulators even more wary and fearful. At least that's my sense in the U.S. And those who have taken a hard line against crypto, frankly, right now are feeling a bit vindicated. And those who have tried to accommodate it may be feeling a little bit burnt. So this intensifying regulatory skepticism, I think, does threaten the business and the value of future investments. And it is something that needs a laser-like focus. It needs to be dealt with. To some extent, let's just be honest, the regulatory resistance may be fed by legacy firms whose business models are threatened by the promise of distributed ledger technology, if that disintermediation actually ever happens and it actually pays off. And there are a lot of very powerful interests who benefit from the current highly concentrated intermediated system that we have. And they do have long-standing relationships with the regulatory community, and they know much. That's an observation, not a criticism, but they know much better. They know the regulators, they know the process, they know how to navigate the landscape much better than a lot of upstart FinTechs who want to embrace regulation, but I'm not sure really know what that means. But in the defense of FinTech, let's not forget that the heavily regulated system, the legacy system that we still operate under, experienced some pretty spectacular failures of its own during their near collapse during the great financial crisis. And though it's a much, much better system today, and I think part of that is due to FinTech, it does remain vulnerable. And those vulnerabilities, I think, will become more apparent as central banks continue to withdraw monetary accommodations that began in the wake of the great financial crisis. This has been going on for about 14 years now, a lot of leverage building up in the system with all those cheap interest rates. And so it's to be determined how this is going to play out. But the current system is better than it was. It still suffers, though, in my view, high levels of leverage, lack of transparency, a lot of rent seeking in certain quarters, especially mortgages, and I'll talk about that a little bit later, and high costs that are too high, especially in payments, which disproportionately impact lower income families. But first, let's talk about how the system has become better, and it's because FinTech has made it better. So let's put aside crypto and distributed ledger technology, because I think that value proposition is yet to be proven, at least in the minds of a lot of regulators. But it needs to be acknowledged that FinTech writ large has made the system, has significantly improved it. It has done this not by fundamentally disrupting the system, which is what potentially could happen with distributed ledgers, but by building on top of the current regulated structure that we have with new innovations and efficiencies. To be sure, this growing FinTech presence in the US and elsewhere has not all been positive. We'll remember the collapse of some promising technologies like peer-to-peer lending during the financial crisis. That didn't work out too well, and we learned the hard way that, and this is true of any firm, but particularly FinTechs, non-bank FinTechs, if you're market-based funded, your funding is highly volatile during market disruptions, whereas deposit funding that you get with a regulated financial system is much more stable. But notwithstanding some of those problems in FinTech during the great financial crisis and its aftermath, FinTech stuck with it, regulators are more accommodative, and as a result now I think domestic payments in the US at least are faster and cheaper. Online platforms have expanded access to financial services, including the underbanked population, and that we've made a lot of progress in the US with our unbanked and underbanked population. Millions still have no bank account or no meaningful banking relationship. And most importantly, I think technology is providing a better, more accurate ways to assess risk and credit decisions and try to get away from some of the current proxies we use for credit, so-called creditworthiness that have a lot of systemic bias embedded into them. So net, what I would call traditional FinTech, again, putting aside crypto, has been successful. There have been tangible social benefits. Even Paul Volcker, who was a dear friend and mentor, in one of the things I do now is I serve as a founding director of the Volcker Alliance, a group that he established. He said famously, when asked about credit default derivatives in 2009, that the ATM was the only meaningful innovation that had been realized in the banking system for the past two decades. Again, statement in 2009, but I think now, if he were still with us, I'd like to think, I would hope, that even he would acknowledge that FinTech has made the system better. Again, look at domestic payments, a lot of new players in this space, most of them, again, building on the banking infrastructure, partnering with banks, but they've also created some competition for banks. This led the banks to lower fees and launch services like Zelle, and I'm a fan of Zelle. It's not perfect, but I think that's a very positive innovation. An improvement in our payment system. Though, again, almost all of this requires a banking relationship for the consumer to benefit. Credit access, so many banks now, even community banks, are offering online the ability to apply for a loan online. This has, again, been done with partnerships with fintechs. Sometimes the fintechs originate the loans, sometimes the bank does. Sometimes the fintechs originates the loan and the bank buys the loan. But there's and there are still obviously some standalone fintech lenders, but for the most part, this whole ecosystem has developed through partnerships with banks, which I think, again, has been positive, especially given the fact, again, that during periods of market turmoil, the existence of deposits, stable deposits to continue to fund credit is very, very important to keep us out of a severe recession. There's a lot of research that has also shown that online platforms have had a nice impact on inclusiveness. They've expanded access to financial services for lower income households as well as rural households coming from rural Southeast Kansas when I was growing up. I think that's a particularly good benefit. A lot of research out there that has documented this. And again, I think FinTech is providing new tools to combat racial bias. One innovation I'm particularly bullish about is the use of cash flow underwriting in lieu of credit scores as a better proxy of how well people can manage financial obligations. So credit scores really are so highly dependent on whether you've got a credit history, whether you borrowed money and paid it back. So if you're an unbanked household that's made regular rent payments and your mobile phone payments and your utility payments, it's changing a bit, but you don't really get a lot of credit for that. And cash flow underwriting is a particularly good way to just have transparency around how well has this person, this individual or household is applying for credit, how well have they managed their finances? And if they have, they're creditworthy, regardless of how many loans they've taken in the past. So there are privacy issues around that. Again, with all of these innovations, you need to be careful. Even artificial intelligence, I think, there have been problems there, but net, I see that as a positive. I do think the more sophisticated analysis that AI provides, the ability to look at a much greater universe of data is helpful. The black boxes that we saw originally in AI that was being used to make credit decisions, which the providers couldn't explain to regulators and did have a lot of embedded bias in them. I think those are the thing going away. There's a company called Pagaya, which I think is interesting. As I understand it, they do identify. There's some 500 factors they do identify. It's not a black box. It's just a better way of understanding risk. And that's an inclusive business model, too, because that firm, I believe, only takes loans that have already been turned down by the bank partner or other lending partner. So it, by definition, is an inclusive approach. That's not to say AI didn't get off to a rocky start. And there's still a lot of regulatory skepticism around AI. And again, I think black boxes are going to be very, very hard to defend. But if the AI provider can actually identify the universe of data that the AI is using, that will put them in better stead with regulators. BNPL is also another mixed bag. I actually wrote a column on BNPL early on. I was net positive on it because it looked to me like it might be a better, cheaper alternative, certainly much simpler alternative to credit cards. And so I still think there's some promise there. The merchants obviously pay for it, so the cost it boosts their sales. So the costs are it's much lower cost for the consumer. But unfortunately, what we've seen with the poor performance of a lot of BNPL loans, this is people are getting overextended with BNPL. They're taking it's a financing. Whether there's no interest rate for a while, there's still hidden costs and fees. Yeah, there's been problems with overdraft, the auto pay, they forget about it, the overdraft fees, data harvesting. The CFPB has done a lot of work in this. They're going in the direction of providing some credit card-like regulation of BNPL, which is probably going to be a good thing. And I would hope, industry would work with the CFPB on that, because I do think, again, that has a promise for a better alternative for some households to credit cards. So there have been many net positives that I think, the FinTech community, the investors who've invested in these kinds of startups, you should be very proud of them. And I think in engaging with regulators, it's good to remind them that it's not been a perfect road traveled so far, but FinTech has made the system better. There are problems with, I would agree with Jamie Dimon's observation where FinTechs have maybe taken over a little too much. And I think the mortgage space is one prime example of that. I had a lot of experiences, obviously, with mortgages during the FDIC, and then I was on the board and chaired the Fannie Mae board for several years. And I would say that it's not a good thing that banks have pretty much gotten out of the mortgage business. So, and I'm really worried about it now. You're seeing our mortgage market, housing market is under severe distress. The non-bank mortgage originators are fine, and they're better regulated now, and mortgage lending standards are better regulated now. They don't have balance sheets, right? They originate, they sell. And in an environment like this, there's really not much balance sheet resiliency. Some of them have servicing too, which continues to bring revenue in. But I would feel a lot better now if there were more banks in the mortgage market. And I think the lack of a bank presence in mortgages is going to make things worse. And that can be using financial technology. It's not like a bank, you have to go to a bank branch to apply for a mortgage. But that is one area where I think the trend has been, and that's not so much driven by FinTech. Frankly, it was driven by the government with an overreaction to any mortgage lending, and then I think some fairly punitive measures against banks, even when they were adhering to guidelines that have been set by the government in guaranteeing loans. They felt a bit burnt, so there's going to be some repair there, but I for one hope banks can get back into the mortgage lending business. So let's talk about FinTech generally, and now let's talk about crypto, because I think you have a very much harder case to make that crypto so far, and the use of distributed ledgers specifically, has really, where's the social benefit? I'm hearing that increasingly from regulators. Where's the beef, right? You promised us all this. You've been saying this for a year. You're going to modernize this. You're going to modernize this. You're going to take risk out of the system. You're going to make the system more inclusive and fair, et cetera. But where is it? That 80% peak to trough loss in the crypto market placed massive market losses. Real economy didn't. The good news and the bad news is real economy could have cared less, because there's really no tangible benefits, meaningful impact in the real economy, as near as I can tell. And feel free to push back, that crypto has had to date. I think. So some of the regulators are saying, well, why is that the case? Maybe it's just easier to make money using a lot of leverage to engage in speculative trading, particularly when capital is so cheap, but that's going away. So some of the craziness in crypto has been fed, like in a lot of other areas, has been fed by cheap interest rates, which is changing. But the actual tangible social benefit for crypto at this point is still, I think that case has not been made. So, and then in terms of decentralized finance, which I would define broadly as just using blockchains generally to provide decentralized financial services that are now being provided by centralized intermediaries that use distributed ledger technology. I've always been very enthusiastic about that, but I think even that has gotten a bad name. DeFi is like, I think a lot of people equate it with Ponzi schemes and scams and manipulation. I just don't think there's a good connotation there, which is unfortunate. And now, of course, so maybe you need to rename DeFi to something else. And of course, now we're kind of renaming crypto. Are we calling it Web3? I'm not clear about that, but there are new names. But is Web3 going to be offering a better mousetrap, or is that going to be a new way to facilitate gambling and gamification, particularly among young people? A lot of young people took a lot of losses when the crypto markets imploded. And I'm sure you've seen the studies that show the governance is highly concentrated in the hands of just a few. So is this disintermediated, or is this just a new way that large players can turn the internet into a pay-to-play venue, in which every activity becomes a financial transaction to be bought or sold? I'm not sure that's a good way this is going, but some of the critics are saying that. So I think I'm not necessarily embracing that as an opinion of mine, but I think it's something you need to be aware of that's out there. It's a perception that's out there. So I've been actually, as I said, I've been very enthusiastic about DeFi for a long time, or the use of distributed ledgers to provide financial services that are currently being provided by intermediaries. My history goes back to 2015. I'm on the board of Paxos. I've been an advisor to a number of companies trying to develop use cases for blockchain, Figure with mortgage transactions, Spring Labs with consumer data and KYC. I'm on an advisor to Wealthfront. Robo-advising, haven't talked about that, but I also think that's a positive innovation too. So I've been looking at this for a long time, doesn't use distributed ledger, but I've been looking at this for a long time. And actually, again, as I indicated, I'm also a founding board member of the Volcker Alliance. In 2015, they asked me to write a book for a chapter that was being published about challenges for government officials and financial regulators in particular, and they asked me to focus on FinTech. And so I was very positive. In preparing these remarks, I went back and looked at what I said in 2015. And it was interesting to see the very list of virtuous use cases for blockchain, which of course included securities, clearing and settlement. Boy, I still think that's tremendous promise, and it frustrates me. The SEC is talking a lot about, getting narrowing settlement times, going to real-time clearing and settlement, but blockchain really hasn't come into the discussion, which I think is unfortunate. Credit reporting, giving consumers access control over the distributed database where their credit records are stored. Real estate transactions, oh my gosh, there is so much rent seeking in mortgages right now. Real estate title insurance, it costs a lot. For a lower income household trying to buy, $150,000, $200,000 house, there's significant closing cost up front. A lot of it relates to just recordation of title searches, title insurance, getting mortgage ownership and transactions onto blockchains, I think, or real estate transactions onto blockchains, I think has a tremendous promise to have social policy benefit. But again, it just hasn't happened yet. Reputation management for the sharing economy. Again, a lot of talk about Airbnb, Uber, other companies using tamper-proof ledgers to manage credentials for guests and providers. Energy grids, know your customer requirements for financial institutions, a little bit of progress there. Philanthropic uses like creating and tracking digital identities for refugees. And of course, cross-border payments, where there has been some work done. And I do think that stablecoins, get my flag up, Paxos, as you probably know, is a stablecoin issuer, but I do think in terms of modernizing the payment system, especially cross-border payments, that stablecoins, well-regulated stablecoins, emphasize well-regulated stablecoins, have tremendous value added. So there's been some progress there. And that's not meant to be an exhaustive list of uses of distributed ledgers that I think have virtuous purposes, good public policy purposes that I think regulators would be receptive to. It's not meant to be exhaustive, but it provides a lot of good examples, and we just haven't seen a lot of progress. And some of that, I think, is due to regulatory reluctance, perhaps, or lack of expedition in embracing the technology. But a lot of it, I think, is some in the industry have just found, it's faster and easier to make money by speculating than it is to actually try to develop blockchain for socially valuable things that would have a true beneficial impact on the real economy. So that's important, because I think in talking to regulators and engaging with them and in getting them to be accommodative or embrace or approve or at least tolerate the new types of innovations that you may be funding, the investors out there may be funding, where's the benefit? I love the fact that the regulatory sandbox that the MAS has announced last June. There are three questions. One of them, what's the first? Is there why is current regulation a problem? Are you operationally ready? But also, what's the benefit? I think that has to start. Any conversation with regulators has to start with this. How is this going to be a socially helpful thing? It's unproven technology. It's technology, again, crypto, that doesn't have really a good reputation right now. And so you're asking them to take risks by coming in and approving something, and they need to understand, what's the benefit of why they're doing this. I think fintechs also need to, whether it's crypto or otherwise, you need to be willing, if you want the credibility of the regulatory imprimatur, you have to understand what that means and the burdens and cost of being a regulated entity. There will be people here representing the legacy system later today who can tell you all about it. It's a burdensome, very onerous, especially prudential supervision, liquidity and capital management, AML, counterfinancing, CFT, operational integrity, non-discriminations, and it needs patience too. You need to have controls around all of that. You need to have governance structure around that. You need to have staffing around that. It costs money. And then you also need to be patient, because a lot of times when you're regulated, that means regulators are going to want to approve things first, or they may object to something you want to do. And that can be frustrating, but it is the way it is, and that's not unique to fintech. Especially with prudential supervision, banking type regulation, that's what you get in the regulated universe. I also think some regulators, fear, I've heard them say this privately, I'm not so sure so much publicly, that what does the transition look like, right? They are used to regulating highly centralized intermediaries for the most part, and that may be a good system or a bad system, but at least a system they understand, they can see it, can control it. But if you're coming in with a new business that's going to disintermediate that system that they're used to, what does the transition look like? Even if you can all agree that it's a good thing to disrupt the current system, how can you do that in an orderly way so there's not public cost and risk as part of that process? So thinking about that transition, I think, is really important. But most of all, you just need to be, anybody who wants to be regulated needs to understand that it is more cumbersome. It's going to slow you down. You need to understand what it really means to effectively engage with the regulatory community, and only by understanding what their job is, what their objectives are, and the fact that it's going to be very, very different from a purely commercial environment. If that's not understood up front, it's going to be hard to have meaningful conversations. For regulators, though, I would also say I think there are things on both sides that can be done to facilitate this relationship. I do worry that regulators now are going to let fear drive decision-making to some extent, just because of all the troubles we've seen in crypto and significant losses. I love sandbox approaches. I hope the U.S. would think about that more. I think that gives applicants some room to innovate and experiment on a limited basis. And it also gives regulators more information to understand what the regulation should look like, what the structure should look like. Their job is not to protect their incumbents, as well as they may know them. Their job is not to protect their incumbents. If technology is providing a better way of doing business, they should let it come, but then again work with the industry to make sure that transition is smooth and is not disruptive. And I also think there's, to some extent, at least in the U.S., there's been an impulse to try to figure it out all at once. What's the whole system should look like? I think this is what has impeded stablecoin regulation, which shouldn't be hard to do. But sometimes it's new. You're not going to be able to figure it out. Regulators are not going to be able to figure it out all at once. And if they do, and I think some are trying now, it's going to take too long. The industry, the market's going to get ahead of them. It already has, to a large extent, in the crypto space. And so understand that you're going to got to start someplace, but you're going to need to have a little more agility and adapt as you learn from this new industry that you are now regulating. There's also, in the U.S., I think there are some unique challenges on the regulatory front for investors and those who want to be regulated. Our siloed regulatory structure, are you a bank product, are you securities, are you a commodity? You need to understand that at the outset to understand who's going to regulate it, much less how it's going to be regulated. Other jurisdictions like Singapore, you don't have that problem. And then I think our legislative, things are becoming so polarized in the U.S., looking to Congress for a solution in the near term. I don't think that's realistic. So I've called for the U.S. regulators to look at their current authorities, get agreement among themselves, how they're going to parse this out, and then roll it out. Because now I do think the markets and these innovations are getting away from them. They're falling behind, and that's not a good situation for anybody. So I would just say, in concluding, there may be some concern that financial innovation and disintermediation could also disrupt the regulators. And if that's the fact, maybe they're worried about that. I don't know. I don't think they should. I don't think that'll be the case. Banking has always, even with the money lenders and the temples, banking lending has always required some type of government intervention. Even Milton Friedman acknowledged, free marketeer that he was, acknowledged the heavy hand of government is needed in regulating the financial system, particularly the banking systems. So I don't think the use of distributed systems is going to change that, even if we eventually finally realize this nirvana of a disintermediated financial system. I think there's still going to be issues of governance around those systems, their design, their operational integrity, their data protection, as well as transparency, which is going to be a hard balance to strike. Same old stuff, leverage, fraud, manipulation, it can all be there. And so the technology may be different, but there's still going to be a need for financial regulation. And again, industry working with financial regulators to help them find out what that looks like. I think that would be a very, very way to constructively engage. Because I think if you recognize up front, embrace regulators, they're important, they do provide value added, they will need to have a continued role, that will advance the conversation. And I think if you work collaboratively, not combatively, in realizing the promise of distributed systems, I think eventually it will succeed. So great, thank you. I have a few minutes for questions, I think, if anybody would like to make comments or questions.
Okay, we have a question there. Can we get a mic there, please?
Thank you, Sheila. Fantastic speech. Mark Müller-Eberstein from Seattle, FinTech investor since 2010, former Microsoftie. You really outlined the opportunities between institutions, institutional investors, regulators, and of course the crypto world as well. Question, that we do see institutional adoption in the back end. Like, for example, you mentioned the international money transfers, and Western Union apparently uses stablecoins already, realizes a lot of savings. What's your guidance for how to make those savings available to the broader masses, especially the unbanked?
Well, I think competition, and I have a long history with this. I used to be the Assistant Secretary for Financial Institutions at Treasury, where international remittances was a key focus of mine. And back then, we were trying to get banks into remittance to provide competition for the Western Unions of the world because the fees were very high. And one of the impediments was that because of many of the immigrants sending money home to Latin America in particular were not documented, they couldn't open bank accounts. So we tried to deal with that. So I think similarly today, distributed ledgers, that competition, if by providing that competition, threat of competition, it can drive costs down even more, all the better. You don't have to disrupt the system if the current system can actually prove it can be as efficient and good as a distributed ledger approach. So I'm agnostic on it. I just want lower costs and better systems. I mean, the amount of money that a working immigrant has to pay to send, money to Guatemala or whatever, it's really not good, and we should all care about that. But I think competition is the answer.